Okay. Happy Wednesday, everybody. We have a special program today. We're going to be talking to Todd Hassey. He's going to join us momentarily. He's with Simple Home Lending and the Hassey Group, and we're going to really dive into where interest rates are going, because one of the things that we're seeing right now is interest rates are really going aggressively. They've been going up aggressively, and we're going to see what he thinks. Where is it going to go? What's the impact of interest rates on the real estate market? So we're going to talk about that, and we'll talk about what we're seeing as far as numbers go. So with that, here's Todd. Todd is joining us.
Hello.
Welcome, Todd. Yes, you're live, brother. I don't play around. You jump in. You're live. I've introduced
Awesome.
you, Todd Hassey, Simple Home Lending, Hassey Group, and the big thing right now is if you could tell us, tell us why interest rates have gone up. Want to get like the inside dirt on that. So tell us what's going on the mortgage side.
Uh, the broad spectrum of things is basically it's history repeating itself. It's COVID, and then going even back further when the bubble burst with all the bad loans and the economy the way we went through that back in '07 and through all the way through 13. That's when all the Fed regs came out to circumvent any repeat scenarios. So we had a lot of knee-jerk reactions when COVID came out because it reflected a lot of the same drama that happened back then when Obama put the TARP funds out there for the bank bailout. And then you had the home affordable refinance program that was a result using the TARP funds. Now had COVID that triggered the same response. And it was basically, the HARP 2, the home affordable refinance program 2. And those that were in dire straits, they were, government was, stepping in to help those so that we didn't have, mortgage default the way that we did back then. And it was kind of a knee-jerk reaction. It was overly done. But the long story short is it's a repeat of, post-Vietnam. Unemployment was at an all-time high coming out of wartime. So a lot of different variations going on today, but it's the same scenario. So now, that being said, unemployment now is starting to go down. And what that means is the economy is slowly starting to do better. And by the late 80s, early 90s, and result of all of that, we saw 17% mortgage interest rates. So, just in a long story short, we have history repeating itself, and it's not going to stop. It's going to slow down, but it's the difference today is that because of COVID, nobody is chained to the desk anymore. So now I'm having all of my buyers coming from California and New York buying up our Florida properties, which is completely creating a supply and demand issue. So therefore, values are going up. And it's going to continue to run until we kind of parallel the dollar per square foot there. These guys are coming down here getting a 30% pay increase just because cost of living is so much lower. So they're buying these homes and forgive me, I'm in my home office and I've got lawn jockeys starting the lawn. So where I left off was that home values are not going to stop. They're going to, as these interest rates rise, reflecting the same market that we came back out of, late 80s, early 90s. It's, history repeating itself there. The mortgage interest rates are going to slow down some of the equity running away from us, the growth that we're having. But it's not going to stop until we get near those dollar per square foot values that they have in Cali and New York. Still, those guys are 30% up in income from where they've come from. So, for them, it's still, even if it's a dollar per square foot, same, price, they're still 30% positive for what they're netting. So that's my insight for this current market. And values are just not going to stop running away from us for a while. It's starting to slow down some, but it's not going to stop running. And I've had no issues getting values, none.
As far as appraisals go.
Yes. So those that are having those issues, I have to say that there's probably some details that need to be reviewed to figure it out. A, it was either overpriced in the first place, which is normally what it is, or B, that they're missing some data. An extra bedroom. Even I've had them even missing a swimming pool, something really ridiculous. So those are my my insights for the market. It's going to continue to run just like it did post-Vietnam. The interest rates, I guarantee we're going to see 7% before the end of the summer, or at least really high sixes, So we're already, investment properties, I'm already in the sixes, and yeah, and that's A paper all day, great credit, good assets, we're in the sixes. I've got a customer right now who's doing a cash out refinance on a condo. Condos have an extra hit to rate, and she's paying an extra point. That's 1% of the loan amount just to buy it down to 5.99. So investments are already in the sixes. Primary residences are without paying points, they're already in the mid fives. So that's just where it's been. And then Christmas, I was in the twos. Everybody else was still in the threes because my pricing is better, but I came from the twos in Christmas.
I want to talk about that. Like Christmas, now it seems like that was like years away, but we're talking 4 months ago.
Yeah.
Right. So when was the last time we saw this quick of a rise? Did we see that post Vietnam?
I've been doing this 20 years. I've never seen this rapid of a rise. To me, the market is just correcting itself from where we left off, about 2 years before COVID.
Yeah, 2018.
So we were knocking on the door of low fives, at that point, and then all of a sudden the market tanked. So it's all the fear factors and election and all that stuff that compounded the everybody being reserved or conservative and holding their money is what it was. Then COVID came.
So I'm not a gambling guy. So the first thing I think of is like what's the over under to getting to double digits? Like what's the possibility? Like I was part of a mastermind recently and they were saying, well, like you're saying, I think there's consensus that, 6, 7, yeah, that's probably, that's almost a guarantee, right? Like and the Fed has actually given us enough warning and said, hey, we're going up. And I know it's kind of priced in the market and I want to talk about that in a minute, but my question is, what are the possibilities of going to 10?
Oh, it's very possible.
Yeah.
I mean, my first mortgage was 1999 at 7.25%, and I was killing it with that rate. So I was happy.
Why do you say that? So you're not just pulling that out of your pocket.
No. No. I'm saying that because history repeating itself. We've already been there. We've already come from it. It's going to go that direction again. We were stable, productive. Everything was awesome. Home values were a little less, and that's what's going to slow the running away. But it's not going to stop because of the COVID. Nobody's chained to their desk, and they still have that cost of living improvement to their income.
Demand
that's the difference now.
Demand has been so significant around the country that and it sounds like what you're saying is it's going to taper demand a little bit, but it's not going to stop it completely.
Right. And we've already been there, and the market continued to perform. So that pulse check for the consensus and the fears that makes everybody sit on their wallet, it's not going to happen. It's just going to continue to go.
So you're not concerned about your business?
No. Everybody needs a home. And the prices and where everything's are, it's usually the largest investment we make in our lives. So normally, we need to have that bank loan to, offset what we don't have for cash. So, and besides that, still a mediocre financial planner is going to give you 8+% return. Mortgage interest rates are still costing less. So why on earth would somebody use their money? And especially now that you can recast. So let's say, for example, I have $200,000 and I'm going to put it into a house. Well, the mortgage is costing me, let's just say it's 6%. Well, if I put in $100,000 and I leave $100,000 out to put with my financial manager or my financial planner, he could get me 8 to 12% return on the portfolio. So that money is going to be better used for me over here with my financial planner. I may even go down to like $20,000 investment in my mortgage, let my financial manager, run with that $180,000. And then at one point in the lifetime of my loan on a conventional loan, I can take all that money out, put it right back into my primary residence and recast. And that keeps the rate the same that I had original from day one. for $150 is about what it costs to record the recasting of the new loan. And I'm basically taking the mortgage balance down and recasting it for the remaining. I don't know, if I started with a 30-year and I'm 5 years in, so I'm recasting it for 25 years. So boom, I've just now lowered my monthly obligation. I put my money safely where it needs to be, which is the equity of my home. So that's what I would do.
So how much do you think the interest rates have gone up? Obviously, the Fed said that they're going to bump up rates as well. Explain the connection, because it's not a direct connection between the Fed saying they're going to raise interest rates, and then of course what ends up happening to the end user, the consumer, as far as interest rates. Explain that relationship between the Fed and the mortgage interest rates.
That I cannot do, because everything that's like, first of all, everybody always asks me, what do you think rates are going to do? And I don't have a crystal ball. Secondly, is it seems like the minute you kind of get a picture on the relationship and what impacts rates, it works to the exact opposite. So there's no magic formula to say 1 + 1 = 2 when it comes to rates and impact on mortgage interest rates. The only thing I can do is look at the bond. The bond is my pulse check for minute by minute whether it's going up or down, and then the predictions of what I hear from others in relationship to stocks and how the market is going to go is then how I look at how it's going to possibly play in the next week with the bond market, because the bond market is the direct pulse check for mortgage industry.
So where can I want to be like extreme? I want to provide a lot of value for the people that are watching. So we know that interest rates have a bearing. Mortgage interest rates have a bearing on what happens with the market. We're seeing that, especially here in the Villages and Central Florida, we're seeing the mortgage interest rates affect only slightly. So it's interesting. We've seen a big jump up in mortgage interest rates. And to your point, the demand has tapered a little bit, but not incredibly so.
Right.
But there's going to be a point where, interest rates, I think mortgage interest rates get to a certain point. Maybe we don't know what that is. Maybe it's, 6, 7, 8. We don't know what that number is, where it'll affect demand even more. How can someone really start looking at this and get a jump on, besides calling Todd, which I want you to put your phone number, tell us what your number is, how they can connect with you in a minute.
Absolutely.
Where can they find the bond rates? What's going on with the bond market? What's the easiest way?
Just Google 10-year U.S. Treasury. That's it. And I often go to I think it's I have it saved here. I'll just tell you.
Yeah, I mean I think it'd be helpful for everybody to actually look at that, pay attention to this, because people are always asking, is there going to be a market crash? Is what's going to happen? And that way, for the people that are watching, you can tell for yourself, as opposed to taking my word for it or Todd's word for it. You can look at it yourself and just look at what the bond market is doing, and that's going to give you a heads up on interest rates, and then it's also going to tell you what's happening with inventory.
Yeah, it's cnbc.com is where I go, and then /US-markets. And then from there, you can, just look at the 10-year Treasury and see what it's doing. Stock indexes, commodities, treasuries, currencies, everything.
Nice.
And the first list right there on U.S. markets is the U.S. 10-year.
So cnbc.com.
Yeah. /US-markets. And that'll take you to the landing page that I look at just, for my selection of what I want to review in detail.
Got it. Okay, cool. I like it.
Yeah, that's my pulse check I use all the time. So
good. I think that's a good takeaway for sure for everybody.
Yeah, I've used that one for about 15 years, so it's worked. So
good. So all right. So what's the biggest challenge that you're facing, or the biggest challenge that people that are connecting with you are facing right at the moment?
The biggest challenge. Turn times. I mean, I prided myself on being able to, do my from applicant or from purchase contract to execution to closing between 2 and 3 weeks. I prided myself on that. Now I've got all these third parties that I have to wait because they're bottleneck of the industry. appraisers. I mean, one of the biggest problems I've had, let alone appraiser turn time, is having, like, for example, an FHA or a mobile home, any unique properties on top of being FHA that makes appraiser have to do the work. Oh no, they're going for the lowest hanging fruit. So now I've got appraisal management companies that take it and they have to send it to 5 appraisers. So in that, they send it out there and it sits and it sits and it sits. And meanwhile, myself, my processor, we're up, the chain at the AMC, the appraisal management company, saying, what's going on? Give us a status update. And meanwhile, everybody else behind us, that's looking for process of the transaction where we're at, is saying, where's the appraisal? We haven't had it scheduled. What's going on? And so that's the biggest problem. The third-party inspections, appraisers being one, the assignment acceptance is the first step. Then it's scheduling the inspection. So I'll have somebody accept it, but then all of a sudden they can't get it back to us for 6 weeks. And then if it's sat there because it's a mobile home on 4+ acres, it's got a 12-stall horse barn. And I mean, just these are the things that I'm running into, that it's taking upwards of 2 months because of the appraisal only.
Right.
And then I've had delays from surveyors too. So anytime we have a purchase transaction where the seller has a survey, please get the survey, because that is a black hole of time for surveyors getting out there. On top of that, these guys, between appraisers, surveyors, if it needs an engineer's report for a foundation certification, if it's a mobile home, those are the things that now these guys are price gouging our customers. So, I had one appraisal that I needed within 3 weeks. The guy had, and it's just a normal house, single family house here in Pinellas County where I'm at. They had to pay $2,000 for that appraisal and still got it to us a week late. Wow. So that's the biggest challenge that I'm having. The third-party inspections, especially the appraisers, and it's all about turn time. That's it.
Yeah, well, that makes sense. And obviously, Todd, you serve a very large geographic area.
Yeah.
Tampa, St. Pete, up the West Coast,
the entire state,
area, right?
Mm-hmm.
Right.
Yeah.
Mm-hmm. So, look, how do people find you, by the way?
The best way to do it, best way to find me is just call me or just look me up, Google me. I'm there. You'll find me through LinkedIn and and Google and most of all just through you and the rest of our colleagues there at Realty Executives.
What's your phone number?
727-439-7867.
Love it. Love it. So recap, 6, 7, 8 looks like a pretty, looks pretty certain, like we're heading in that direction.
Yeah.
Even 10% plus down the road.
Yeah. I don't doubt that we're hitting, double digits next year. I mean, just based on the way things are going.
Wow.
And it's almost a double whammy. We've got values running away from us, but I think that the rates are going to put the slowdown on some of the value running away from us. But then at some point, that value being so high is going to put some of the brakes on the mortgage interest rates as well. But again, history repeating itself. I don't see it stopping. One may slow the other down, but and in this case, I think it will slow down the escalation of equity that we're growing for the last 2 years that we've seen. That's the only thing. When we come out of winter going into spring, everybody always looks at spring as though, things are slowing down. Well, no, this is some areas of Florida don't slow down, they get better, such as Ocala, the Villages, that area, they actually, all of our snowbirds come down and buy at that time. But for the most part, industry-wide, nationwide, the winter months are slow, and it's not till late spring does it really start ramping back up. So these people that are on the bandwagon with what I call media hype and the fear, feeding that beast, I think it's just an illusion right now. So Todd, I think we're going to see values continue to run as they have been.
I love it. Todd, thank you very much. Well done. Thank you, brother.
Thank you, man. Have a great day, and thanks for letting me be involved. Again, if anybody wants to reach me, please call me at 727-439-7867.
Call Todd. He's an expert.
Thank you.